Welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates. Securities offered through Peak Brokerage Services, LLC. Advisory services offered through the Retirement Guys Formula, registered investment advisor. America's Retirement Headquarters, America's Medicare Associates, and the Retirement Guys Formula are separate and independent entities from Peak Brokerage Services, LLC. I want to welcome you into and thank you so much for joining us here on America's Retirement Headquarters, home of the Retirement Guys Formula, America's Medicare Associates, and Retirement Tax Partners. 419-794-3030 is the phone number. That's 419-794-3030. You can find out more about America's Retirement Headquarters. Set up a time to speak with them at arhq.com. My name is Chris Swan. Today on the show, how can tax planning now pay off later? How retirement is different today than for your grandparents, and steps to take if you find yourself in an unexpected retirement. All this and more, but before we dive into it, let me check in with the one and only Mr. Nolan Baker. Nolan, glad to be with you once again. How are you, sir?
Just enjoying the beautiful day. If you're listening to the show here in Toledo and you're out and about this afternoon, you haven't been by the headquarter building yet. Today from 3 to 6, we have our car show going on here at America's Retirement Headquarters. Beautiful day to get out. We got a lot of cool cars, clients, and friends and family that are going to be joining us here in the parking lot at America's Retirement Headquarters today from 3 to 6. Also, I know before the show we were talking a little bit, Chris, there that last weekend was graduation for my youngest son at Anthony Wayne.
That's right.
Up until a couple of months, I don't have any more kids in the Anthony Wayne School District. They're all both alumni. Carter will be heading off to Florida Atlantic University August 9th, going down to college there. And tomorrow we are going to be celebrating his graduation party. So lots of exciting things going around both the headquarters and the home front here at my house.
Appreciate you taking time out of your what sounds like a very busy schedule this week, both work and business and home life to spend with the listeners here. But a lot of great milestones to celebrate, and that's the same sort of thing when it comes to retirement. You want to be able to celebrate and enjoy those milestones, hopefully without having to worry about, am I going to be okay in retirement? The team at America's Retirement Headquarters, they can help you out with that. So once again, the website arhq.com. Set up a time or give a call 419-794-3030. Some of the Trump tariffs have been reduced or removed as trade deals have been evolving, but many of them are still in place. So when could we feel their impact on what we buy? Economist Jeremy Siegel tells Fox Business that he's looking at summer and that the Fed, in the meantime, should sit still.
I don't think we're going to be seeing the effects of this tariff until maybe June or July. This is tariff-induced inflation. Long-term inflation rate indicators are not going up, and the Fed should not be reacting against a supply shock. It should be reacting against a demand shock, and we're not getting a demand shock either from the tariffs or the fiscal policy or money supply growth.
Investors, and as a result, Wall Street has been so reactive to information like this. If you jumped out of the market in April out of fear of the tariffs, you might be kicking yourself. You might regret it today. So, Nolan, what advice do you give to clients on when they should change their investment strategy?
Yeah, that's a popular topic to know about. When should you change your investment strategy? If you listen to a lot of the news and the media that highlights that, it can get your emotions involved and lead you ultimately to wanting to make more shorter term emotional decisions. So really what I want to do is I kind of want to walk you through when you should change your investment strategy, maybe some of the reasons why, and what it's going to do is it's going to help you avoid making some of those short-term costly decisions. Those people who recently made a change in the beginning of 2025, when the market went down because of the talks of the tariffs, maybe they got out of equities, went into more fixed income. They missed one of the best run-ups that we've seen in the month of May in the stock market, really dating back to the 1950s. So we had a really strong 6% gain in the S&P 500 index. And again, those short-term emotional decisions can lead to long-term pain. But there are reasons why you should change your investment strategy. And you may be thinking, is my investment strategy still working? Are you sticking with a plan that's no longer designed to accomplish where you're at in life? In this segment, again, we're going to walk you through 4 smart ideas to know on when to change those investment strategies. It's really going to be designed to help protect you, again, help you remove the emotions of investing, to focus on staying on track and avoid that short-term noise. So number one, what you want to look at is major life changes. Here at America's Retirement Headquarters, we are helping people that are transitioning in life. You know, they have been growing their retirement dollars to get them to retirement time. And, you know, retirement, if it's near or it's just recent, I would say is one of those life changes that happens. And what you want to do is you want to try to shift from usually what's mostly a growth-oriented strategy to a strategy that is more income-focused. You might have a portfolio that you've been putting into your 401ks for years, and you've been growing, and that's exactly what those working years were designed to do. You could even be in a target date fund, but with a target date retirement account, what you end up with is a combination between stocks and bonds. It's kind of a set it and forget it approach. And as you transition into retirement time, it's no longer the time to just set it and forget it. What we do is we follow a process. It's called the independent income system. And within the independent income system, what we do is we teach you how to take your dollars that you save for retirement and ultimately put them into a different bucket type of an approach that each account is designed to do a specific thing. If you're not going to get up and go to work every single day, you need to make sure that your money is working as hard as possible. And one of the things that you need to have is you need to have that steady paycheck, right? You've been used to those paychecks that come every 2 weeks or how often you get paid. You want your retirement to get up and go to work for you every day. So you need to have a bucket of money that's designed to provide reliable income. When you think about tariffs and we talk about, you know, inflation, and you look at the long-term impact of what inflation will do for a retiree, it's also going to be important that you have a bucket of money that's designed to provide you some type of an inflation pay raise in the future. That pay raise could come maybe if they reduce what your Social Security payments are, like the government talks about doing in less than 10 years, or just because life gets more expensive. And then you can have a bucket of money, and that bucket of money for the long term can still be your equity part of the portfolio. So if you have these reliable income, pay raise, you have an emergency account, then what happens in the short term in the market really just becomes noise. It doesn't really impact your strategy. You know, when you have all of your money subject to the lottery of the returns of the stock market, that's where your emotions can get more involved in, you know, making these shorter term decisions based upon market news. You really want to understand what your withdrawal strategy is and focus on creating that tax efficiently plan when you're looking at life changes. The number two reason to consider changing your investment strategy is because market or economic conditions shift. Now, here's what I want you to do. I want you to first take that headline news that has you either, you know, looking for an opportunity or feeling uncomfortable about the market. And what I want you to do is I want you to ask yourself this question: will this matter in 5 years? Because if that headline is not going to matter in 5 years, then it's probably not a reason to change your overall investment approach. You know, when you look at the tariffs and you look at the things that we had talked about for the tariffs, I believe that you can go back to history, going back even to the 1920s, and we can see, you know, well, what did the market do short term and long term when we have tariffs, right? Short term, the market tended to react more volatile, just like it did this time. You know, but long term, those tariffs had very little impact on the growth of the market over a longer period of time. Again, moving in April to a cash position because of the tariff news made an investor miss out on one of the best markets in May that we've seen, again, dating back to one of the best times since the 1950s, 1957. If you're going to look at using market or economic conditions, what I would encourage you to do is I'd encourage you to have a defined investment strategy that would indicate, you know, why and at what point would you move in or out of the market and adjust. I generally don't recommend that people move all in or all out of the market, because you've got to get it right twice, right? You have to decide when exactly to get out of the market, and then you have to decide when to get into the market. If you're using market or economic conditions as indicators of when to make a change in your investment strategy, what I would recommend that you do is use that on part of the portfolio that allows you to reduce equity, but not go completely out of equity, reduce equity or increase equity exposure. A good example of one of the things that we look at here at America's Retirement Headquarters in our investment committee is looking at the moving averages of the market. If I go to Yahoo Finance, I can look at, say, the S&P 500 index, and then I can look at the 50-day or the 200-day moving average of the market. And in essence, when the market's above the 50 or the 200-day moving average, that could be a positive indicator for the markets in the short term. Where on the flip end of the scale, if the markets are below the 50 or 200-day moving average, that could be a negative short term, meaning that maybe that would be a reason for market conditions to lead you to want to maybe reduce your equity exposure. Number three is a reason to make a change to your portfolio is if your portfolio gets out of balance. What you want to do is you want to know what your target allocation is. A common target allocation that you hear for retirees is like a 60-40 mix. So it would be 60% equities and 40% fixed income. Depending upon, again, what your desired outcome is of your mix, let's say it is the 60-40 is your goal, then when one of the categories gets above or below 5%, that would be an indication of when to do a rebalance and make those investment changes. So if your original plan 60-40, equities are doing great like they have over the past couple of years. Now your equities are 70 and your fixed income is 30. You're 5% over. In fact, you're 10% over. So that would be a reason why to make those changes and rebalance your portfolio. You can also look at doing that rebalancing at set timeframes. A good example is maybe every quarter you would go in and do that. We use a system called Plan Confidence where, we help give strategic advice to folks on how to allocate their 401ks. And a good thing to do is maybe look at it on a quarterly basis. You really don't need to be going in and rebalancing your portfolio on a weekly basis or a monthly basis. Again, you want to look at those predetermined points when something gets out of the norm when you would make those changes. Market short term, if the market sells off, maybe then you're out of rebalance, you would move from fixed income. And instead of worrying about the tariffs, it would have created an opportunity to say, hey, the market pulled back 15%. There's a buying opportunity based upon a predetermined point of when the market goes up or down. In our example, maybe more than 10% would be another reason why you'd want to look at taking profits when the markets have short-term run-ups and or buying on short-term dips. And the number 4 reason why you'd want to consider making a change to your portfolio is you're not meeting your long-term objectives. You want to, again, define what the outcome is. I had a great couple that just recently came in, and what I liked about their portfolio is I liked the fact that they had very strong pensions. Both of them are retired. They were blessed to work for companies that offered great pensions. And that pension is going to provide a huge foundation for them. So when we looked at their 401ks and we looked at their personal investment savings, what they had communicated to me is that they were extremely risk adverse. Most of their money was invested into fixed income like money markets, savings at the bank, and CDs. And again, depending upon where you bought your CD and what the rate is, let's just say that the rate of return is 4% on a CD. If you take 4% and then you're going to pay taxes on it, you take 25% out for taxes, now your rate of return is 3%. And then if you subtract inflation, the problem with that is if the long-term objective is to have an account that's designed to give you a pay raise, but you take 4 minus 1 for taxes, and minus another 4 for inflation, they're actually slowly losing purchasing power. There are other financial products that could give them more growth potential than what they could get in their savings or money market or CD accounts that have more growth potential and or vehicles that would give them a level of future income, regardless of the outcome of the market, without having to take that market level risk. So again, you kind of want to define what your objective is. You want to look at what your long-term investment time frame is. We use a financial planning software called Right Capital, and within Right Capital, it can take and put in all the information about a portfolio and give you an analysis about the ins and outs of the portfolio, and it'll tell you the probability of success of being able to reach their long-term objective. Your objective might be $5,000 a month of retirement income. And a thing that could impact that is based upon how you have your investments allocated. Again, if your investments are too conservative, you may not be able to keep up with purchasing power. On the flip end of the scale, if your portfolio is too aggressive and there's a near-term major market sell-off, that could have a big impact on the sequence of returns for a near-term retiree. So looking at making a change to your portfolio, if it meets those objectives, if it's not, then that would be a reason to. So again, major life changes, you're talking about market or economic conditions shift, your portfolio is out of balance, or you're not meeting your long-term objectives. Those are reasons why your investment strategy maybe isn't a set it and forget it type plan. It should be evolving with you as you evolve throughout your life. You know, whether you're nearing retirement, you just moved into retirement, you're maybe simply not hitting your goals and objectives. Those are the reasons why you'd want to take a look at making the change. And again, when you think about the news headline making you want to make a change to your portfolio, before you do that, ask yourself that question, will this matter in 5 years? And if it's not going to matter in 5 years, it's probably not a reason to make a change to your investment strategy short term.
And should you find yourself in a scenario where, you know, these all do align and you should make that investment change, understand it's maybe not something that you want to do on your own. Still find a way to take those emotions out of it. The team at America's Retirement Headquarters can help you with that. Take a look at that, better define your personal independent income system, and make those changes accordingly. But it all starts with reaching out, setting up a time to speak with them, 419-794-3030. Or you can go to the website, find out more about the independent income system, and reach out right there at arhq.com. 9 years ago, someone asked country music icon Alan Jackson if he plans to retire soon. And here's what he said.
I've told this before, I don't know what I'd retire from. I don't work much now. But I'll just like to do like some of my heroes, like Willie Nelson. I'm still working some of them and playing as much as I can. And if I get tired, they slow down a little bit. And I'll just probably do the same thing as long as I'm still enjoying it and the fans are still enjoying it.
Well, fast forward to now, and the 66-year-old says a nerve illness is actually making it difficult for him to perform. So he is retiring from touring, a final show being planned sometime next year in Nashville. Someone's health is one of the reasons that they may look at a forced retirement. When this happens, whether it is health or other situations, how do you help your clients?
Yeah, unexpected retirement can really feel like a setback. But with the right plan, the good news is it becomes an opportunity to live the life really that you wanted on your terms. The key here is three things to do. You want to pause, assess, and plan with intention. So I'm going to walk you through how to apply that to your situation. So if you got into an unexpected retirement, again, I want to walk you through what steps to take so you don't have a blow up on some of the things that we've seen other people with experience in the past. So number one there, we talk about the word pause. And I say pause, don't panic. So what I think you should do is try to avoid taking large withdrawals from your retirement accounts, especially if you're under the age 59 and a half, because then you could be in a situation where you have additional tax penalties because of your age. That income gets stacked on top of your work income, and all of a sudden you get in big trouble. So we've seen people lose their jobs, and they say, hey, I just want to cash in my 401k. I'm going to pay off my car, pay off my mortgage, pay off my credit cards, or whatever the case happens to be. And all of a sudden their retirement accounts wiped out because they paid off some of these debts that they had, and they ended up getting stuck with additional tax bills because of their age, and then they had taxable income as well. And now what they did is they kind of focused on their short-term needs and really destroyed their long-term retirement goals. So you do want to focus on some of your short-term needs. I'm not saying that you can't take withdrawals from retirement accounts, but only take enough to maybe keep you going. Don't take major withdrawals out of your retirement accounts to pay off mortgages or cars or credit cards unless you know what the financial impact of it is going to do to the long-term success of your retirement, as well as having a conversation with your CPA or accountant about the taxes that could be owed on that. Number two, what I want you to do is I want you to assess your financial situation. In our terms, it's called create a financial inventory. In creating the financial inventory, what I want you to do is I want you to have 6 to 12 months of emergency money saved up to cover living expenses. I want you to try to cut out some of those non-essential expenses that you have. I know when we think about maybe kids, because I have one that just graduated high school and one that graduated college, I think their needs tend to be a lot higher for birthdays and vacations and maybe what it used to be for our grandparents. And if you have an unexpected job loss, some of those things are going to need to wait, and you got to cut those non-essential things out. If the stock market is close to or at a record high, which here in June of 2025 is about where we're at, consider reducing risk. So if you had an unexpected job loss and you're going to rely upon some of your income in retirement from your investments, and you have an equity-focused plan, which you should if you're growing your assets and you have plenty of time, but now all of a sudden unexpected job loss happens. If the market's at a high point, I want you to consider reducing some of that risk down. So that way, if there's a major sell-off in the market, it doesn't compound the negative impact of losing the job. And now the market's down, and now you need the money, and now you're selling at a loss. Luckily, as of, again, the date of this recording, the market's doing good. But if the market is at a terrible point, and that's one of the reasons maybe you lost your job, you've got to be really careful about changing strategies after a loss already occurred in the market. Number three, what I want you to do is I want you to review your healthcare coverage. When you're reviewing your healthcare coverage, you have the ability, you could reach out to our team here at America's Medicare Associates. Scott, Troy, or Dan could kind of walk you through your different options. But your options are going to fall into two categories. It's going to fall into COBRA, and it's going to fall into the healthcare marketplace. I guess you could say three. And the third choice is do nothing and don't get healthcare coverage. I would say I would avoid that. Again, 30 years of experience. I can think of a situation where a gentleman unfortunately lost his job earlier than expected, was in a situation where they had pretty decent health, really hadn't had any health issues that came up along the way, decided that they would just not get health insurance until they got to Medicare age at the age of 65. Unfortunately, in that situation, the husband got cancer, and as we know with medical bills, I think it accumulated a $500,000, and unfortunately, he passed away. And so what the hospital did is the hospital ended up suing the wife in that situation and just created a major financial strain. I can think about, things that you should pay for. I talked about cutting out non-essentials, but health insurance, I would consider that to be an essential item to have in retirement time. You can get COBRA insurance, or you also have the ability where you could go through the affordable health care. Under affordable health care, navigating the marketplace that's out there and deciding a plan that meets your needs as well. And then the fourth thing I want you to do is I want you to stress test the impact of withdrawals on your long-term plan. So if the plan's unexpected, go back into that 401k planning software, or if they don't offer it, use something like Right Capital, or in the financial planning, retirement planning, start to take a look at what withdrawals look like if you started taking withdrawals now and decided maybe you didn't want to go back to work. You might actually be pleasantly surprised that you're already in a situation that what seemed like a setback now turns into an opportunity that you have the ability where you can retire early, more on your terms. I know of another individual that was looking to retire in probably 2 or 3 years from now. Their company decided to close the business here in Toledo, and their option was to move to a different state. or go ahead and take a severance package. And, when we ran the numbers, they were able to take the severance package, and by doing so, they were able to actually get into retirement time 2, 1, 3 years earlier than what they previously did. Again, stress testing the impact of those withdrawals will tell you what your long-term goals of success are. I believe that you want to kind of have about a 90% probability of success when you're confident about moving into retirement time. Those can be the couple of different areas when you're taking a look at how to figure out steps to take for an unexpected retirement.
And of course, we hope that's not a situation you find yourself in where you're forced into retirement before you're ready for it, whether it is a health situation, whether it is a job situation. But as the Boy Scouts say, and as something that the team at America's Retirement Headquarters really holds true, is you want to be prepared just in case. Think of it like a fire extinguisher you've got. You don't want to use it necessarily, but if the situation arises, you are grateful for it. Having that plan in place, the team at America's Retirement Headquarters can help you create and revamp it as time goes on by giving a call, setting up a time to speak with them. 419-794-3030. Things have also changed when it comes to retirement planning. Nolan, can you tell us how it's, quite frankly, not your grandparents' retirement anymore?
Yeah, I love it. After 24 years of being on Toledo's largest talk station here on the radio, we've talked about the fact of retirement is not like it used to be, and it's really not your grandparents' retirement. You can't really use their playbook, if you will, for figuring out how to position your own individual retirement. I mean, it's good to learn lessons. I know I've learned a lot of lessons from my dad and my grandparents as well, and those life lessons are also very valuable. But in this segment, really what I want to do is I want to talk to you about 4 key ways retirement today is completely different. We're going to walk you through some of the pros and cons and what you need to know to really make sure that your plan is adapted to where you're at today in your journey. Number one, what you'd want to look at is people are living a lot longer. So you're going to want to expect to have a longer retirement. The risk that we're talking about here is called longevity risk. And there are ways that you can address longevity risk. And a couple of ways that you can address longevity risk is annuities would be one common example. Annuity is an insurance contract, and there's different types of annuities. There's, again, complete segments that we have on annuities talking about the pros and cons and ins and outs. But essentially, you have a contract with an insurance company that's designed to provide something guaranteed by that insurance company. And one of the things that you can do is you can get an income payment. That income payment could be either for a set period of time. It could be a period for the rest of your lifetime. If you're married, it could even have the option of having a joint payout for both of your lifetimes as well. So one of the ways that you can address longevity is you can get some insurance to insure against that type of risk. The second way that you can do that is focus on the income producing assets of your investments. As an example, in retirement time, not just having growth oriented stocks, focusing maybe more on dividend paying stocks. So if you have dividends, they tend to be more predictable than the ups and downs of the daily noise of the stock market. And in addressing longevity risk, one of the cornerstones of your retirement is going to be Social Security. There's a large percentage of people that just claim Social Security right away at retirement time and, take it before what's considered their full retirement age. You can even get a higher benefit if you delay taking Social Security to the age 70. But the great thing about Social Security, and I know Social Security is in big trouble, and it's broke like most of the other parts of the government, but Social Security is a contractual governmental guarantee that you're going to get this amount of money, and they're going to pay that income for you for the rest of the lifetime. And it's inflation adjusted income as well. So making the right decision and maybe sometimes consider delaying Social Security can be a good way to help you with your longevity risk. And then also to deal with longevity risk is being too conservative. I talked in an earlier segment about clients who were very risk adverse and had chose to put the majority of their money into fixed income investments like money markets and CDs. And although that gave you peace of mind on your statement, when you subtract the amount of money that they're going to pay in taxes and inflation, they're actually slowly losing money, which for longevity risk does not work in their favor. So number two is pensions versus your personal savings. My grandparents used to go work at a company. You'd work there for 20, 30 years. You'd retire. They'd give you a pension that lasts the rest of your lifetime. Usually included some benefit for your spouse if you passed away earlier. Being here almost at 50 years old, for my generation and younger, pensions are a thing of the past. But the nice thing about pensions is, the pension for our grandparents would protect, in many cases, what they needed to live off of for their basic income needs. I think those same principles apply today as they did for our grandparents. Investors today, or retirees today, are really forced into saving for themselves in a 401k or an IRA. And so when you move into retirement time, what you want to do is you want to look at protecting that minimum monthly income needs with non-market risk investments. So you want to have enough reliable income that says, if the stock market doesn't go up or down, it doesn't have a big impact to the outcome of your monthly income needs. So shifting those risky assets to things that provide more predictable income. Again, example of that is you can use annuities that provide lifetime income benefits, have more dividend-focused investments. And if you don't want to do that, then what I would recommend is to at least have like a 5-year bucket of money worth of backup plan. So if you need $1,000 a month out of your retirement account, you want to have $60,000 set aside in an account that's not subject to the lottery of the returns of the stock market. And why I say that is because at some point the market will go down. And if you're pulling $1,000 a month out of your investments in a declining market, you don't want to be selling off your investments when the market's going down. So in a declining market, you can shift withdrawals over to that backup account, not being forced to sell your investments where they're temporarily down. In this case, 5 years, I think, would give you a pretty good probability of success that the market should recover. And again, you can adjust your withdrawal strategies, not selling when the market's down. Number three, I think technology has improved dramatically in this industry, and that's a good thing to help you become a more educated investor. In the good old days, I used to have to pull open the local newspaper and look at the price of stocks and figure it out. Or if I wanted to figure out fees and expenses and performances, I'd have to look through a couple 100-page prospectus and go to multiple different places. It was a long process to be able to figure out the ins and outs of a portfolio. Today with technology, we can find out how optimized an account is. Is an account put together and constructed in a way that mathematically gives them the greatest odds in their favor to achieve the outcomes that they want to do. With technology, we can instantaneously stress test the plan that says, what would be the impact if I paid off my mortgage? What would be the impact if I took Social Security later versus early? What would be the impact of a market decline? What would be the impact of, my loved one or me going into a nursing home? And we can instantaneously, see what those results are because of technology. So retirement planning is very much improved today. The Social Security decision, I've seen some of the stats, and more people are delaying taking Social Security. And I think it's because of the fact that Social Security optimization software is out there, and it's showing people that collecting Social Security early may not be their best approach on how to get the most lifetime income out of the benefits that they pulled in. I think technology has improved in a lot of the portfolio software that's out there. We use a couple of different ones, and one of the ones that I like Morningstar. When I go on to Morningstar, I can look at financial statements. I can look at, what are the insiders of the company doing with their company stock? Are they buying? Are they selling it? I can look at the analytical data, and granted, I'm a numbers nerd, but I can look at like the price to earnings ratio. I can look at the dividend yield. Investors who own mutual funds, you can look at, what are any upfront or back-end sales charges. What are the annual operating expenses of the fund? And you can get that information pretty quickly using tools like Morningstar. And then the third in that category, or the fourth, I should say, is looking at using software to do tax planning. Developing a strategy that takes, the numerous laws that you have in the form of taxation and applying it to your situation to look for ways to reduce and minimize the amount of taxes that you pay. Says technology has improved to help make you a better educated investor. The fourth thing that is a little bit different on how retirement's different than in the past is chronic illnesses. We have America's Medicare Associates here. Not only helps with people that need health insurance before 65, but also Medicare, then Advantage and Supplement, but down the road dealing with the issue of long-term care. In the past, if I go back to, say, like my grandparents' age, if you think about like a diagnosis of cancer, a heart attack, a stroke, a lot of the times those were pretty terminal illnesses that you got. Today, with the advancements that we have in the healthcare field, people are living a lot longer with those chronic illnesses. And, what comes along with those chronic illnesses is helping you maintain control and independence. It also comes with maybe a heightened risk that you might end up in some type of facility, to need long-term care. The stat that I saw is it's, less than, I think, 5% of people have long-term care insurance, and being the fact that it's, a pretty high risk that if you or a loved one needs long-term care at $4, $5, $10,000 or more per month, you want to have a plan in place that's designed to leverage your assets. Again, this is an area where I think the insurance companies of America have evolved from our grandparents. So if I go back in time to 20, 30 years ago when I got into the business, a common solution years ago was to buy traditional long-term care insurance. And there's good thing and the bad thing about traditional long-term care insurance, but the insurance companies of America have really evolved today to provide a lot of different solutions to help a couple be able to protect their assets without having to erode their retirement accounts. You could have a life insurance that allows you to accelerate your benefits if you have a critical, a chronic, a terminal illness while you're alive. It just doesn't have to be life insurance for when you pass away. The insurance companies of America have evolved with annuities that offer income riders. And, those income riders are designed really to help somebody maintain more control and independence if 10 or 15 years down the road or longer than that, they need long-term care. So there's been some evolution. And when you think about how retirement is different today, it is a lot of positives. And then you have the negatives, like so much news media in your face all the time. So if you feel like you're stuck in the past and your retirement plan is not keeping up with today, I'd love to have a conversation with you and then show you some of the different tools and resources that we use to help make sure that your retirement is staying up to date with all the latest and greatest that's offered today.
It's as easy as setting up a time, reaching out, giving a call, 419-794-3030. There are certain things, I think, challenges that we face these days in retirement that your parents, your grandparents probably weren't even on the table, probably hadn't even considered. Perhaps you have not considered them yourselves, but now is a great time to go ahead and get some answers, get a little bit of clarity to those questions you may have towards your retirement. Once again, reach out, 419-794-3030 to set up a time to speak with the team at America's Retirement Headquarters, or go online to arhq.com. What's the third most common mistake people make as they plan for retirement? Oh, an article that I read recently said it is failing to factor in taxes, but this could be complicated if we try to figure it out on our own. Nolan, can you give us some examples of how tax planning now can pay off later?
Yeah, you've worked hard, saving and accumulating your money to get to retirement point. And you've probably spent a lot of time in figuring out the investment asset allocation, figuring out, what type of products to own to achieve your goals and objectives. But, one of the biggest threats to your retirement success is taxes. And so that's why tax planning now can really pay off later in life. In this segment, really, I'm going to walk you through 6 smart tax strategies that can help you get more of what you've earned, keep more of what you've earned, reduce that tax bill, stretch your retirement income even further. And they're not loopholes. They're just really smart legal moves that the wealthy have been using for years. We have here at America's Retirement Headquarters, one of our companies is called Retirement Tax Partners. And so with the Retirement Tax Partners, Danny's been very actively involved in helping our clients create what if tax analysis. In essence, what they do is they take their tax return from last year and we look at, what is the tax return going to look like this year? And then we say, what are the possible steps that we could do to try to help reduce and minimize the taxes that family's either going to pay that year or some point in the future. So here's 6 takeaways that I have noticed as we've gone through doing these tax what if analysis for our clients is number 1, consider making Roth contributions into your 401k. Working with hundreds of families and helping hundreds of families retire over the years, I would tell you that a general trend of my retired clients that are what I would consider to be financially successful are clients who have saved well for the future. So they're out there in their early years. They're spending time on cruises, visiting with family, taking destination vacations. They're doing those home improvement projects that they want to do. They're spending as much money, if not more, in retirement than when they were working. So conventional wisdom has said your tax rates will be lower in retirement time. And to me, in looking at the 30 plus years of helping families retire, if you're successful in your saving and investing, you're going to enjoy those retirement years, especially, in your earlies and 60s and 70s, that your tax rates may not be lower. So deferring taxes and putting money in a traditional IRA or 401k, a Roth IRA or a Roth 401k may be better off. It also may be better off because what you end up doing is you're going to pay taxes on the seed, meaning that contribution that's going in. But if you follow the rules correctly with a Roth, the advantage of that is you have the ability to potentially pull that money out tax-free in retirement time. And think about the compounding effect over 10, 15, 20, 25, 30 years that the average saver or retiree, what the compound growth of that contribution could be. So you're better off paying taxes, in my opinion, oftentimes on the small balance versus waiting to pay taxes on the harvest or the large balance at the end. Now, that may not make sense if you're a high income earner right now and you think when you retire, your income is going to be significantly lower in retirement. Number 2, I have noticed a lot of people that fall into a trap called voluntary taxation. There's 3 buckets of money that you have. You have taxable, tax deferred, and tax free. So your goal is to shift money from the taxable category to the tax deferred. And that's where I would say 90% of the population stops. What I want you to do is I want you to take it the next step and try to shift as much money as possible towards the tax-free category. I'll give you a perfect example of that. We'll call her Heather. So we were looking at Heather's tax return, again, with our tax company. And what we had noticed is that Heather had a lot of dividends and interest and capital gains. Now, at the end of the day, the reason that you invest is to generate income, to generate profit. So again, profits and income are a good thing, right? But the reality is how that money was invested, she's not using it right now. She's going to use it in probably 5 or 10 years when she retires. So even though she's not spending the money because it's in a fully taxable account, those capital gains and also the dividends and interest were showing up on her tax return. And every year the government was asking her to pay 22% in federal taxes on that income, even though that she wasn't using it. Instead, what she could do is she could take and look at shifting that money into other categories that could provide either tax deferred or tax-free benefits. So as an example, a fully taxable money market account, depending upon what the goals are, utilizing something like a municipal bond could provide some federal tax-free benefits. Making sure that they're making contributions every year into the Roth IRA could shift money and get more money over into the tax-free category. Deferring taxes to later can help get compound growth. So I want you to, number 2 is to avoid voluntary taxation. If you don't know if you're paying voluntary taxation, if you look on your tax return, you're looking at that first page, you're looking for dividends, interest, capital gains. Those are the items that you maybe have a little bit more control over of how to position those assets in an account that can be a better outcome to reduce your taxes. Number three is you want to think about the timing of withdrawals for purchases. Common theme of somebody that is successful in retirement, in my opinion, is somebody who doesn't have debt, right? They don't have a mortgage. You may be thinking, I'm getting ready to retire. I'm just going to take a withdrawal from my 401k or my IRA. I'm going to pay off my mortgage. But what you don't understand is that the withdrawal that you take from your retirement account in a traditional tax-deferred 401k or an IRA, that income is going to be stacked on your other income that you have, like your work income. That ultimately could push you into a higher tax bracket. In addition to that, depending upon when you're going to get your health insurance, if you get health insurance before the age of 65, under the Affordable Health Care, depending upon what you take out with withdrawals from retirement accounts, that can be considered fully countable income to determine if you get a credit or what your health care cost is under Affordable Health Care. If you're over 65 and you're on Medicare, if your withdrawals go too high, you can face an excess Medicare premium, and you're known as IRMA. Taxation of your Medicare benefits go up as well. So you got to be careful on how to take the money out. You may be better off paying off the mortgage. I conceptually agree with that concept, but instead of paying it off all in 1 year, maybe working with a CPA or a tax professional, maybe it's better off to pay it off over 2 or 3 years, knowing how that impacts your overall large purchase or your large payoff that you're looking to accomplish. So run the numbers before you just take a big withdrawal. Talk to your accountant or CPA. Know what the impact looks like before you do that. Number four is looking at end of the year capital gains planning. If you have investments that are not retirement accounts, you're going to ultimately end up with having some gains that could be from buys or sells that were done throughout the end of the year. And sometimes at the end of the year, you have the ability where you could sell if you have some investments that are, quote, your losers, and use those losses to offset capital gains and help you in a situation where you don't get surprised by having a large capital gain bill. I would recommend on your calendar every year in late November or early December, you just put it on your schedule, put it as a reoccurring activity so it happens every year. If you have a non-retirement account, to review your end of the year cost basis information and know what your realized gain loss report looks like. Number five is looking at charitable giving if you're over the age 70 and a half from your IRA. I think donating to your church or a charity or a cause that's important to you is fantastic. I think, that's one of the great things that Americans do. I mean, we really help support some of the causes that are important to us. And if you're giving to charity and you're over 70 and a half, you might be able to do qualified distributions directly from your IRA to the charity of your choice. So again, consider donating directly to the charity from your IRA versus taking the withdrawal from your IRA, paying taxes on it, having that money go in your checking and savings account, and then writing a check out to the charity, because then the tax bill falls on you. It could be more tax favorable if you do charitable giving directly from your IRA. And number six is if you plan on leaving money to your loved ones, know what your tax bracket is and know what their tax bracket is. When we were doing these what-if analysis, there was two people in particular that when we looked at their tax return, they had owed zero federal income taxes, right? So on the surface, you're like, fantastic, right? Didn't pay any federal income taxes. And you talk to them a little bit. Both of these couples were financially successful. They really, besides being forced to take required distributions out of their account, probably were not going to spend through all of their money. Their then goals really have kind of shifted to helping out their kids and grandkids. And they know that most likely, unless there's some type of major healthcare expense, that they're going to leave a legacy to their loved one. So what they could have done is they could have taken some of that money. Number one is if they had non-retirement accounts of appreciated stocks and maybe they wanted to help a child out with college, they could have looked at gifting strategies to gift some of those highly appreciated stocks to help maybe kids or grandkids pay for college. Or in their situation, both of them paying zero in taxes, if their kids are not going to inherit money at a 0% tax rate, which most likely is the cause and case, then they may want to consider doing some Roth conversions and finding out how much money they can convert while they're in a lower tax bracket than what their kids would do when they inherit it as well. So tax planning now can pay off for you in the long run. Again, you probably just got your taxes finished. You probably put them in the drawer. You put them in the box. You put it in the attic. You put it down in the crawl space. You put it away. But this is an area, I'm telling you, that we've seen real life examples of people doing these what if analysis, that tax planning now can pay off later. It's worth your time to take an hour and get a tax what if analysis done by our tax team at Retirement Tax Partners.
As the saying goes, an ounce of prevention is worth a pound of cure. Taking the time now to plan for the years ahead can really benefit you as far as paying less in taxes. You're going to have that what-if analysis run by the team at Retirement Tax Partners by reaching out right now. 419-794-3030 to schedule the time. Once again, that's 419-794-3030. Or go to the website to find out more about the entire team and set up a time right there at arhq.com.
America's Retirement Headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. You can reach them by calling 419-794-3030 or online at americasretirementheadquarters.com. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Nolan Baker is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstance. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Nolan Baker, Ohio Insurance License Number 27787.